Oracle Corp is in the information technology sector, subsector system software. As you can see by looking at the long-term fast graphs here, the company has been a very consistent double-digit grower. Growth has averaged over 12.88%. The company started paying a dividend in May of 2009 and have steadily increased that dividend almost every year since at a much higher rate. When you put price on the graph, monthly closing stock prices, you can see that the stock price generally tends to move in line with the company's operating results. And you can see clear times when the stock is undervalued, when the price is below the line. You can see periods of overvaluation, and you can just by looking at a graph like this, see how overvaluation can affect your performance. You can also see periods of undervaluation, which turn out to be the optimum time. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And, I've been writing about a lot of dividend growth stocks here recently because dividend growth stock investing is primarily where my major focus is. But one thing that's really, I think, important about value investing is that value is not just about buying a stock when it's real cheap. Value is also functionally related to the amount of growth the company can achieve. And what I've been really talking about in more recent videos has been slower growing or average growing, even higher yielding stocks. Today, I'm going to switch and look at some fast growing stocks in the information technology sector, companies that offer double-digit growth of both earnings, income, and even stock price appreciation. And so we're going to look at four that I think you can look at as research candidates. And, I probably would only pick one or two of these if it was me. I want to give you some more healthy growther stocks that have been trading at decent valuations for the most part. Some of them have come down in value, as Oracle did, as I showed in the previews here. But we're going to go through these here. We're going to create a portfolio. I've created a portfolio here for you. And I've titled this portfolio Total Return because what you're really focused on here is total return. All four of these companies are in information technology. Two of them are semiconductors. One, NetApp, is a technology, hardware, storage, and peripherals company. And then Oracle is known as a system software company, as I originally alluded to. So we're going to take a look at all four of these in alphabetical order for you and analyze why I think these stocks would be interesting research candidates that you might want to consider for your current portfolios. So let's go ahead and start in alphabetical order with AVGO. Now, what I also want to do here is I want to show and I want to illustrate, because I get a lot of questions from subscribers to Fast Graphs about this. Fast Graphs is the Fundamentals Analyzer software tool. And as such, it is very dynamic and allows you to analyze fundamentals and fundamental growth. And everything, as I mentioned, value investing is also functionally related to growth. The faster a company grows, the higher the rate of return expectation you can expect, as long as you buy that stock at a reasonable value that is commensurate with the growth that the company is achieving. So growth and value, in a way, are joined at the hip. I'm going to make that clear. Now, when I first look at this graph, I see that the company has traded at around 15 times earnings. The actual normal PE over this time is 14.78. That's, rounded to 15. The growth rate of earnings over this time frame, and that's from point A, to the end point B, is averaging over 32%. But I want you to analyze that. When you're looking at a graph or using fast graphs, I want you to make sure you're looking at the data. The one thing I recommend is always check the graph key here and look for the growth rate and the PE ratio. When you have a fast-growing stock like this one has achieved, then you're using the formula price-earnings ratio equals growth rate that was made famous by legendary investor Peter Lynch. So what I've drawn here is an orange line on this graph of a 32.18 PE ratio, which is equal to the 32.18% growth. But that's not really a realistic PE ratio for this company. Here you can see the blue line is much more realistic. But the reason that that number is so high, you've got a 232% growth rate in fiscal October of 2010. And then 2011, it was 23% growth. Then it dropped to 3, 4, and then we had a 70% year in 2014. So you can see that growth is somewhat, erratic. So the first thing I'm going to do is I'm going to take out or call out the 232% growth rate. Now we see that the growth rate has shifted to 23.77. So the PE ratio of the orange line on this graph is now 23.77. The blue line is still around that 14 or 15 number. It's 14.36 to be precise, but you can see there's many times where it traded at above a 15 PE ratio. So I'm getting a little better picture of the company. I cut a couple of more years off, and now my growth has gone back up to 27%. But once again, that's basically, averaging some real high growth years with some flat growth years. So I'm going to drop this all the way down to 7 years. And what I've got here now is about a 15% growth rate. And again, I've got that PE ratio of 15.34. So what I've been able to ascertain so far by looking at the fast graphs and using the dynamic feature and running the different time frames is, first of all, a 15-ish valuation is a pretty solid valuation. It's something you can really hang your hat on when you're looking at valuing this company as far as whether it's a good buy, sell, or hold. Growth rate has averaged about 15% in the last several years. And, but that again will have a 30% year mixed with a 2% year, a 4% year, a 26% year, another 30% year, and so on. Okay, so one thing I'm looking at here, but notice how the price has really moved in line with that 15 growth rate. Now, if I look at performance over this time, I get a couple of very interesting things. One thing is we see the dividends grown by over 39%, and the company's capital appreciation has averaged just about its growth rate, 15.96%. Add in the dividend, which has been more than the S&P 500 paid over the same time frame, and you get an outperformance of 18.39% against the market of 11.8%. But I also want to make another point. This company started paying a dividend in 2011, and they've actually increased that dividend over that time frame. If you look at this long-term time frame, at over 40% a year. So growth is a hallmark of these technology companies. Now, as far as forecasting goes, analysts are still expecting double-digit 15+% growth over the next couple of years. But once again, that's 38% for this fiscal year, which ends in October, and then 8% and 8% following. The long-term growth rate is expected to be about 17.8%. So more of the same, if you will. Remember, these numbers are not right because they're forecasts and they're not perfect, but the idea is, are they within a reasonable range? And when you're looking at a company like Broadcom here, symbol AVGO, you've got a company that can give you double-digit growth and certainly growth of dividends. So when you're looking at getting a total return on this company, you're looking at getting it from a function of growth plus income, plus capital appreciation. Now, I don't consider this company excessively cheap at this valuation, but I do consider this company reasonably valued here. So we don't have a great margin of safety, but we do have growth to compensate for that. So there's Broadcom. That's the first one I want to point out. Now, another thing, since this is a dividend-paying stock, I'm going to now look at it from a standpoint of operating cash flows. Now, what I'm interested in here, I'm going to take price and the normal PE off the graph, because what I'm interested in is the operating cash flow covering the dividend. In other words, they have plenty of cash flow to cover the dividend, and the answer is yes. And I will also look at this through the point of view of free cash flow. And the company also covers their dividend with free cash flow, and they have since 2015. It got pretty close where they had almost 100% payout ratio in 2014, but otherwise their free cash flow has covered their dividend. If I look at sales growth of the company, sales growth has averaged over 21%. I consider that a very attractive growth rate as well. So all in all, I think Broadcom offers a real good, interesting look today with a nice, almost a 3% dividend yield, 2.97. And, it's got growth potential going forward. So if you like healthier growing companies, then a company like Broadcom or AVGO, symbol AVGO, might really fit your bill. Now, this is a very competitive industry that the company's in. And, I think that's worth mentioning and that's worth talking about. The company does compete with some of the big firms, that I think you should obviously be aware of that when you're looking at companies like this or any of these tech sectors. But a lot of them compete with each other. The company faces competition in analog devices from companies like Cisco, Cree, Marvell, NXP, which I'll be also talking about, and others. And then in the infrastructure software market that they also operate in, they're competing with the likes of Cisco, CrowdStrike, IBM, Microsoft, Salesforce, Oracle, and VMware. So there's a lot of competition in the industry for these companies, and I think you should be aware. That's why I've given you 4 choices here to look at. So the next stock we're going to go to, we're going to go down the line in alphabetical order, and we're going to look at network appliances, I like to call it, or NetApp. And I'm going to start, sales has been averaging double-digit rates, so that's good to know. I'm going to look at earnings growth has averaged over 19%, been a little more cyclical. They started paying a dividend in 2014. Dividend grew, modestly for about 3 or 4 years. Then they increased their payout ratio. Everything below this white line is the portion of earnings they're paying out to their shareholders. So you can see, this is also offering 2.77%, over 2.75% yield. The company does have good long-term performance from the standpoint of the growth of the dividend has averaged over 19% per year growth. And it did freeze the dividend in 2021 and had a, rather modest, but there was back in 2019, they did raise their dividend by almost 100%. So it doesn't have quite that predictability of some of the, aristocrats and dividend kings that I showed before, but it does offer good income, does offer good yield, and it does offer growth potential. Analysts are looking at, just under 10% growth over the next couple of years. The long-term growth rate is expected to be about 9%. So again, this gives you a good, shot at earning some decent returns. This has a little better valuation than I saw with AVGO based on that growth rate. So I think you're looking at a little more rate of return potential from this company, a slightly better margin of safety. And again, those are things that I think you should take into consideration when you're looking at the stock. These stocks are all, growthier than what the other ones that I've shown you here in the past. Once again, if I go through the metrics here and look at things like operating cash flow, I see their operating cash flow has covered their dividend. And then I'll also look at free cash flow. These are kind of tests to see how safe the dividend looks to me. Free cash flow is covering the dividend quite well. So I think we have a safe dividend here. And if we get some decent growth, we've got an opportunity for that dividend to increase. Let's put price on the graph. This one, from a cash flow point of view, is trading at a fair value, but from an operating earnings point of view, this gives us the best margin of safety historically. And looking at it from a forecasting point of view, again, it has a minimum amount of safety and about a 10% growth rate. So network appliance looks attractive to me at these levels with almost a 3% yield. The next stock we're going to look at is NXP Semiconductors. This company is, been growing at a rate of almost 20% a year long term. They did have kind of a down year during COVID. You can see how, again, the price tends to move where the earnings go. It's significantly undervalued today on a historical basis. Looking at forecasting, expectations are for 13% growth going forward. The longer term growth rate is expected to be about double digit, again, about 12%. So again, the key factor here is that we have growth potential. If I look at the performance of this company since 2010, you can see that they've outperformed the stock market as measured by the S&P 500 by quite a bit. They've only been paying a dividend since 2018. I want to point that out. But if I look at their dividend already, it's almost mirroring it's almost matching, I should say, the S&P 500. And yet they've only been paying it for a short while, for about 5 years over time. So we've got good dividend growth. The yield is just under 2%, 1.83%. And I think we've got potential for long-term growth. Once again, when I go through and look at operating cash flows are really strongly covering the dividend. And if I look at free cash flow is also covering the dividend like a blanket. So these are a little better growing companies. I don't use valuation with free cash flow. I want to keep that in mind. The company's sales growth has averaged about 9% a year, trading a little bit at a premium to price to sales. But nevertheless, I think NXP Semiconductors is worth a look at these prices. Now, Oracle is the company I opened with and I featured in the beginning. What I like about Oracle is probably the most established here. The company has, started paying a dividend since 2009. You can see it was really significantly overvalued coming into 2022. In October of 2021, it was really trading at a peak value. The stock corrected. It's maybe a tad pricey now. The growth rates averaged almost 13% a year. Forecast growth is about 11% for the next couple of years. Long-term growth is kind of more of the same, 13 or 14%. That would make this a very attractive long-term hold. I would like to get this one a little cheaper. I'm actually long this stock and I do own it. I've owned it for several years. So I'm in, really good position on this company right now. And, I feel real good about it as a long-term investment. Again, these stocks are very competitive. When I look at it from a standpoint of its operating cash flow, again, the dividend, they did have kind of a bad year cash flow-wise, but it's still well covering the dividend for an operating cash flow. Free cash flow has gotten a little closer, but it's expected to recover strongly. So I do think the dividend is safe here. It's a triple B plus rated company. So I like Oracle. I would like to get Oracle a little cheaper. I just want to make that point. But I think Oracle is certainly in value now. You could buy it today, but I'd like to get it when it was a little cheaper. So, the point of this, the real story here that I want to basically focus on is that you're looking at growth here more than I have been in some of the stocks I've shown you recently, which have, modest 5 or 6% growth, even lower growth rates than that. These companies have double-digit growth potential. They have pretty good dividend yields for considering the growth aspect of the companies. Most of them are pretty healthy at this stage. So I think these are all stocks that you can conduct some good research on if you're looking for total return in your portfolio. I think there are selections here that might fit your needs. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, saying thank you for watching the video again. If you like this video, give me a like, ring the bell, subscribe to the YouTube channel, and also you might take a look at subscribing to FastGraphs. It's a very powerful tool, and I've been using the new version of the tool, which, by the way, for those of you who are already subscribers, we plan to be launching that possibly as early as by Wednesday of next week is what our target date is for right now. And, we're testing it and making sure there's no bugs. If we come up with anything that might delay that, but right now it looks like we're on track to do that. Thanks for watching, and talk to you guys soon. In the next upcoming videos, I'm going to continue looking for growthier situations in other sectors. So I'm looking for dividend growth stocks that give you the opportunity to get a little growth in your portfolio at the same time. Thanks for watching.